Okay, class is in session, and what we're going to talk about today is tax-free retirement. I like to call it tax exempt. Tax-free, tax exempt. Either way, let's kiss income taxes goodbye. So now you've learned everything happening from people living longer to government spending in the United States and all the reasons why we'll see higher income taxes down the road. But what if there was a way to legally not have to pay income taxes in your retirement years? Whether you retire or not, it's another story. But in those years where most people do retire, 60s, 70s, 80s, and even 90s, what if you did not have to pay income taxes during those years? In fact, in this example, I'm going to show you how it works with an indexed universal life policy, and we've illustrated it for you. So get your pens out, get some paper out, let's take some notes, shut your phone off, and let's concentrate, all right? So I know you remember the 4% rule. If not, go back to the previous videos, and you'll come across that also in the concepts section. Now, just to reiterate, 4%, if you say 500,000 and you were going to take 4%, which states if you take 4% of your savings for the rest of your life, you shouldn't run out of money. Well, that income would give you $20,000 a year pre-tax. After you pay some taxes called 20%, you're left with $16,000. Now, what I want to show you here is a life insurance index universal life illustration that's just going to be a different ball game altogether. So here we go. So in this particular illustration, I like to work with a 45-year-old man, good health, non-smoker. He's committed to putting $10,000 a year in for the next 20 years. In other words, he's going to contribute $200,000 total. Now, when he gets to age 65, and you can see it, the very first year he takes income, that planned annual income is $26,642. Now, if you go a little bit to the right, you're going to see a number there. The accumulated value is $335,554. Not only is this not 4% of $335,000, but the $26,000 number is actually 7.9%. And you can potentially take this $26,642 for the rest of your life, as you can see. Now, go down to age 74. You've been taking income for 10 years now in this particular scenario, and it clearly shows you. You have laid out $200,000, and you have already taken an income of over $266,000. Now let's go down to age 84. Again, you've put no more money into this. You've laid out $200,000, and you've now taken over $532,000. And this will continue for the rest of your life. But what if? What if the market doesn't perform the way it should? What if? What if that happens? This company in particular that I'm illustrating has something called Lifetime Income Benefit Rider, LIBR. It's LIBR. Now, I don't know of any other companies that do this, but if markets don't perform, they're essentially going to allow you to use your death benefit to create an income stream, and this income is 100% guaranteed. And there's no extra charge to have this, they just include it. So let me show you how it looks here. Okay, so same scenario, you put in $200,000, and in year 21 at age 65, because we elected the lifetime income benefit rider, it's a little bit less money, and I would say if the markets don't perform, we're going to work off the death benefit rather than the cash value. Okay, so it's a smaller percentage, but you're still able to take over $20,000 a year. And just know, and as you can see, in 10 years, you would have taken out $202,000 after contributing $200,000. And when you get to age 84, again, you still contributed $200,000, but you were able to take income of $404,000 in retirement. And this is important. And just also know that this money is tax-free or tax-exempt. It will not affect the taxation of your Social Security or anything else that the government may determine becomes taxable because of your income level. So this type of income is not reportable to the IRS. It's completely tax exempt. And this is guaranteed as well. So on that note, just know that you have options. You could put your money into a retirement account, hope the markets perform, and then work off the 4% rule or find some other alternative where maybe you could lock in some sort of guarantee via annuity or whatever, or you can transition and start properly funding a cash value life insurance policy, which will give you the ability to take money out potentially for the rest of your life completely tax exempt.